On the other hand, the US dollar is very strong. Maybe it's overvalued. That means other things are undervalued. When you look at foreign currencies, for example, where do you see the value?
I like the commodity currencies. My outlook is that the global growth will continue. That we could get a little bumpy patch in here, but in my opinion, the commodity currencies, those countries that are making something that the rest of the world needs. Norway has been a long-term favorite of ours. Their economic fundamentals are just rock solid. I think Australia is a good place to look at right now, and again, a commodity-based currency, an economy that's doing well, and I think will continue to grow.
At the 2018 Symposium on Natural Resources Investing, and I'm joined once again by David Stockman of David Stockman's Contra Corner. How are you, sir?
Very good.
It's good to see you again here after
Great
last year.
Great conference. Happy to participate once again. A lot of really fascinating topics.
Yeah, it was. And our discussion last year was very interesting. Did actually very well on YouTube. And I joked when you came up. I said, well, I named your talk. I sold the house. I sold the stocks. I sold the wife. I sold the kids. Now what? So tell the viewers what you talked about a little bit.
Well, I am an optimist. I truly am. If it weren't for the fact that central banks are totally out of control. So my talk centered on the great 20 trillion elephant in the room, which is the balance sheet of all the central banks of the world in excess of what it probably should be in a rational, stable, historically prudent world. And it's that 20 trillion built up over the last 2 decades that has basically distorted everything. Falsified prices, repressed interest rates, caused an explosion of debt. 20 years ago there was 40 trillion of debt in the world. Today there's 250 trillion of debt in the world. The leverage of the world has gone from about 1.3 times, debt to income, which is manageable, which has been stable and productive historically, to 3.3 times, which means that the world has basically created a huge temporary prosperity by burying itself in debt. And that was what I was trying to get some dimension on in my talk today, because we take these things for granted. In other words, this has been building for so long now, 2 decades, that when you have central banks this massively intervening, intruding in financial markets, we take it as a matter of course. Or when you look at the size of the debt, public and private, people assume it's always been that way. It hasn't. So we need to understand that and ask what shoe is going to fall when, and how much longer can this fantasy be sustained. Those were some of my points.
People, I guess that is an area of inquiry, right? Like, what is the right amount of debt? What is the right amount of leverage, right? Somewhere between what we used to have and what we have now.
Well, it's an interesting question because as far as I know, the world in the 1950s and 60s and 70s did pretty well. In fact, real GDP growth from 1954 to 1972, let's say, was 3.8%. In the last 12 years, it's been 1.4%. In other words, it wasn't that we had too little debt and the world economy or our domestic economy lagged and suffered and underperformed. No, the opposite is true. The more debt we build up, the more difficult it has been to drag the economies forward, because they're obviously laboring under this mountain of debt. Now people say, why has this recovery been so weak, so tepid? It's only been 2% plus or minus, and if you go all the way back to the peak, and remember, when you have a big deep recession, you're supposed to spring back out of that very strongly. We never did, so the trend rate of growth for the last 10 years is the lowest in modern history. I say that's a function, a consequence of all the debt we build up. It was fun while it lasted, but now, more or less in the economic sense of the word, it's the morning after. And policymakers, central bankers, politicians don't understand it, don't know what to make of it, and are going to make huge mistakes that will bring the party to an end. Like Trump today carrying on this crazy trade war worldwide. Now, he has a point that we haven't created good jobs, that we've offshored a lot of our economy, but it's not because tariffs were too high, in Europe or Canada. It's a monetary policy. In other words, it's the result not of bad trade deals, but bad money. And somehow we haven't even begun to cope with that core problem.
We don't have the charts with us now, but you put up a couple of interesting charts about how tariff levels have been going down globally for decades.
Yes.
And places that you expect that might have high tariffs, they're really, in aggregate, actually not very high, like Canada. So do you remember some of those numbers? Like
Oh, yeah.
Under 2%?
I mean, the point is, worldwide, the average tariff today is 2% of imported goods value. That's a hill of beans. It doesn't amount to anything. Ours happens to average 1.7, which is like second decimal point. Canada is 1.59%, and France is 1.94%. Well, it's a rounding error. Nobody has meaningful tariffs on most of the goods that are conveyed in world trade. Now, there are some other problems, non-tariff barriers and so forth, but what Trump is trying to respond to is not the result of tariffs or bad trade deals. He should be not looking at the Canadian border or the French the German automobile industry. He should be looking down the street at the Fed, because that's where the whole problem started. The Fed has basically driven the world to this kind of totally unsustainable debt-driven system.
Sovereign debt yields, you talk about that. We've had negative sovereign debts for a long time. You point out the fact that Argentina can get away with selling 100-year bonds. That's very interesting. And so I'm trying to think, because I think you asked who would buy this? Like, why would someone, except for like some kind of very fast day trade?
Right.
Maybe these people think Argentina is such a periodic and reliable defaulter. They think that they could maybe go several cycles and have them put it together, like survive. And by the time it comes mature, yeah, sure, they've defaulted, but somehow they've put it back together.
Yeah, well, that's a good point. And I always say the central banks have basically destroyed price discovery. Yeah. We don't really have capital markets anymore in the old sense of a marketplace where savers brought their money and investors brought their needs, and one was put together with the other. And so therefore you had long-term investors who would make a decision about what is the credit profile worthiness of Argentina over decades, and should I buy a 100-year bond with a 7.5% yield? And the answer would be hell no, right? But today we don't have investors anymore. It's all a casino. They're all day traders, hour traders, nanosecond traders, and you don't have a stable economy if at the heart of it you have basically a casino and gambling, when capitalism needs capital markets, real capital markets with real investors who are discounting real information. And none of that happens today. They all just look for the latest smoke signals from the central banks and decide whether it's risk on or risk off today.
Yeah.
No, that's no way to
that's
invest.
What they do. Yeah. But in this case, if the duration is long enough, the probability of default is 100%, but we might be dead.
That's true.
To just kick the can down the road.
Argentina defaulted as recently as 2001, and all of us are still here. So in our lifetime, they've defaulted more than once, actually. Yeah. But the point is, and it's not just Argentina. I was pointing out, what did this $20 trillion central bank elephant in the room do? And one of the things is that it drove yields on sovereign debt, the debt of government, to negative territory. I'm not talking about real inflation. I'm talking about nominal. Cool. You were actually paying to own government debt. Well, first of all, that's a crazy-ass idea, right? Yeah. But secondly, 13 trillion of government debt as recently as a year and a half ago was trading at negative nominal yields. Now, this could never happen in a million years in an honest capital market with real investors investing real money for the long haul. And it's just another symptom of the distortion and the malinvestment really that has been caused by what I would call omnipotent central banking.
Right, so that's one side of it, or the first block of it, I guess. Yields going ridiculously low. Then you have assets going to sky-high valuations.
Right.
I want you to talk about Tesla later, but first let's hit Amazon, because that's the actual one example that you used.
Well, I used it today because obviously when you drive interest rates to rock bottom, the price of real estate and equities is the inverse of the interest rate or yield, because a lot of it is owned on carry, on leverage, and so the cheaper the carry, the more you can bid and still make your return. But we've now turned the stock market into the ultra casino, and I used Amazon as kind of the ultimate poster child. It's trading today at $875 billion a market cap. Its operating free cash flow in the most recent 12 months is $5.5 billion. So what I said to today was, it's trading 160 times free cash flow. Nothing is worth that, even if you had a monopoly franchise on distilled bottled water at the Fountain of Youth. In other words, mathematically and financially, nothing could ever be worth, for any period of time, 160 times free cash flow. So, but it isn't just a matter of curiosity and crazy overvaluation. This then feeds through to the economy. When you tell Jeff Bezos you're worth $150 billion and you don't even have to make a profit, just keep doing more of what you're doing. Well, obviously he's going to go out and try any crazy thing that might have a life to it. And if he loses money, he loses money. And he's going to go out and price things that destroy competitors based on break even at best, or even losing money because the market doesn't require his $150 billion of personal worth to produce any profit whatsoever. Now, I understand about startups in the first year, second year. This company is 3 decades old, okay? Yeah. It's got 230 billion of sales, or whatever the number is last time I checked. It needs to make a profit to have a value, and the market, a real market with price discovery, would be disciplining Amazon in a way that would cause it to perform far differently than it does today. In other words, I do agree. It's an innovator, it's a disruptor, but it's also a predator, because the casino has enabled the people who run it to basically ignore every kind of economic rationality, every kind of requisite for how you generate a profit and sustain it. Ignore it completely and get richer and richer by the day. This thing is going to, I want to tell you, the crash of Amazon will thunder across the planet. 2 years ago, February 2016, it was worth $225 billion. Today, as I said, it's $875 billion. Do you think in the last 2 years they've really generated $650 billion of new value? I mean, and they haven't made one dime of profit in the interim to speak of, and their cash flow is actually lower today than it was in 2016. So this is a measure of how far the casino has gone off the deep end. We have these cycles, 8 or 9 years, it gets worse and worse and worse. The bubble keeps inflating, and then they say this time is different, like they did in April, and that's April 2000, and that's how I ended my speech. I showed that in 13 days, the NASDAQ 100 went from 4,600 to 3,100. Right. 33% decline in 13 days. Ultimately, it dropped by 83%. Yet back then, you can go dig it up, it's in all the media archives. This time is different. We're nicely above the 50-day moving average, and if any problem develops, we'll see it coming and get out of the way. Well, obviously, a lot of people didn't get out of the way, because that was in April 2000. That was one of the biggest bloodbaths in the financial system in recent memory.
So certainly creating $600 billion in value, definitely not. This is the anticipation of that. Still a big number, obviously. Let's move to Tesla, since you mentioned discipline and markets and things like that. More than interest rates at play there, meaning that what's going on at Tesla is not simply just interest rates.
No, it's just speculation. No, I think it's just the same speculation that took Amazon to $675 billion, or Netflix, which has never made a dime and is burning cash like a couple billion a year, to the absurd value where it is today. I think 200 billion a market cap. Tesla is, it's a wreck. It's one of the biggest con jobs in modern history. The idea that somehow he has a secret formula to make an electric vehicle is ridiculous. If the market develops, they'll all be there. BMW will be there, Porsche will be there, Mercedes will be there, Toyota will be there, and all these people know how to make a car. He doesn't know how to make a car. They're making them by hand, as you know, in the last couple of days of the last quarter in a tent, in order to say he made 5,000 that week. It turns out they're all sitting out in a field somewhere waiting to be reworked. I feel strongly about this. I was in the auto business. I know what mass production takes in terms of discipline, what it takes in terms of building infrastructure carefully over time. Tesla isn't a car manufacturer. It is a con. It is a con. It is the greatest short of this cycle. If someone really, would like to, has a strong stomach, go out and short the damn thing, because it'll go to zero one of these days. It's just living off raising new money. I mean, anybody can do that as long as you keep the con going, and it will end up being the poster boy. I mean, the poster boy for this greatest bubble yet of this century.
Wow, the pets.com.
Yes, yeah, only much bigger. A market cap of 60 billion going to zero. You can feel that happening. Pets.com, maybe it was a couple hundred million, and it went to zero.
Right.
Yeah. So.
All right, let's leave it at that. David Stockman, thank you for joining me very much. Appreciate it.